Are you holding millions in Facebook or Meta stock from RSUs or a great investment? Do you want to diversify your concentrated positions and defer capital gains into the future? If so, long-short direct indexing might be a great solution. Hi, I'm Todd with Integrity Investment Advisors, and we specialize in helping clients with concentrated positions diversify and defer capital gains. This is a powerful strategy. Watch our video and learn more. We can help. First, congratulations. Consider yourself very lucky. A lot of these holdings are up 4x, 10x, or even 60x over the last 5, 10, or 20 years. It's also created two massive problems. First, you likely have millions of dollars in unrealized capital gains. And second, your financial future is completely tied to the fate of one or a couple companies. You are one bad earnings report or competitor or regulatory change away from serious losses. Concentrated risk is a great way to make a lot of money. It is a way less than optimal way to preserve your wealth over time. You want more diversification. BlackRock did a study of top 20 performing stocks over the last 10 years from the S&P 500. And as you can see in this chart, they had a significant rise over the previous 10-year period. But after that, because of competition and changes in business climate or whatever, the next 10 years seem to stagnate quite a bit. So what this speaks to is performance for stocks can move up quite a bit, but over the next 10 years, there's going to be more competition, more struggle, and maybe a flattened performance. So this really speaks to why we want to diversify out of concentrated positions to better position you for long-term success. So if you have between $2 and $10 million in a taxable account and you have highly appreciated stock, RSUs, or gains and even mutual funds and concentrated positions, something you might want to check out is AQR's long-short direct indexing. And one of the great strategies is their long-short 250, 150 strategy. You can follow Brent over at Tax Alpha Insider. Great slides he has, and he covers a lot of these different events. But in essence, over about a 2-year period, if you have $3 million, $5 million, or something like that in taxable gains, you can defer those gains from your concentrated position into a fully diversified portfolio and keep it in the AQR strategy over time. So it will track the index like the Russell 3000. AQR is striving to achieve some alpha or outperformance over the strategy. They have shown they've been able to do that over the years. And then you get direct indexing with tax loss harvesting. This is much better than long-only direct indexing and something you should really consider. So here's a great slide. Like I mentioned, you want somebody who has access to long-short direct indexing, specifically with probably AQR, we think is the best solution out there. But here's a slide that shows the evolution of taxable investing. It started with mutual funds back decades ago. You really don't want these in taxable accounts anymore. They're highly tax inefficient. A lot of them converted over to ETFs. ETFs are much better, much lower tax drag, much cheaper as far as fees go. But what has happened over the last couple of years is a lot of these companies like Morgan Stanley, BlackRock, Goldman, even Fidelity, Vanguard, and Schwab have all started selling and pushing really long-only direct indexing. It really is an expensive solution, much more expensive than ETFs. It might add a little bit of tax alpha, but really not that much. And down the road in years 3, 4, 5 plus, you end up being stuck just like a mutual fund. So I say no, you don't want direct indexing. If you have this already, we can actually take these holdings and convert it into long-short direct indexing, especially if you have millions of dollars in a taxable account. This can help a lot. So long-short direct indexing is very powerful. We have a whole page on this, and you can find out more. But the goal is to beat the index. You actually, with AQR, have an alpha overlay to outperform the index. It's personalized, so you can use it to mitigate concentrated positions. You can use it to help you selling your business, different things like that. It captures losses much faster and more persistently than long-only direct indexing, and it's much more optimal than an exchange fund. So we really like long-short direct indexing. Again, you can benchmark to the Russell 1000, the Russell 3000, and it does provide some pre-tax alpha. And AQR has a long history of long-short direct indexing. We can show you the details. So if you have concentrated positions, please book a free second opinion. We have this great process where we'll go through, we will review your tax situation. Everyone is different. We have a discovery meeting where we can explain the strategy. We can talk to you in more details about that. We will gather your data on your actually lot level taxable gains, where you have that, how much you want to diversify out of, and how quickly. We will give you a report and run those for tax projections and tax loss harvesting over a 2 or 3 year period, and show you how we can fully diversify that over that period. Normally, these are a massive value add for clients. You can sleep on it, and then if you want to get started, you can do that. Keep in mind, when you start this program matters, right? So capital gains are on a calendar year basis. So we can still tax loss harvest quite a bit of losses this year. And then obviously in January of next year, it'll reset for the full year, and more tax losses can be achieved and tax deferral for those gains down the road. Book a meeting and we can go through your situation. And this material is informational only. It is not tax advice. Please book a meeting. Please work with your CPA or tax professional to work on your own taxes. Thank you so much.